Hi, this is Larry TABB, founder and CEO of TABB Group. I'm here with Laurie Berke, principal at TABB Group. Laurie is working on our new Institutional Equity Trading 2009, our sixth generation of this report, I think, or maybe it's five. I don't know, too many to count. One of the topics of discussion that's been a great issue over the last couple of years is what's happening with order flow. We saw the demise of Lehman, the concentration of JPMC and Bear Stearns last year, Merrill, Bank of America, and the whole idea that now all of this order flow that was has been consolidated or gone from these larger firms will go to a whole bunch of smaller guys. And we've seen a lot of new startups play out. Now we're starting to see the dynamics change to a certain extent. The buy-side firms have less assets under management. The fees are down. They need to concentrate those assets with certain relationships. But now we're seeing a different dynamic come across with the IPO calendar and the offering calendar starting to heat up, and that has another different dimension on that. So, Laurie, why don't you try and talk on how is the calendar, the increase in IPOs and banking calendar, how do you think that's going to impact order flow and what we're seeing from the different firms?
Yes. To your point about concentration of flow, last year when we talked to buy-side traders for our fifth annual buy-side trading study, we found that the concentration of business with core firms, core brokers, had become extreme. We found that on average, buy-side firms, long-only traditional asset management firms, were doing just under 75% of their business with about a dozen brokers. And as a matter of fact, about a third of the buy-side firms were doing 3/4 of their business with 10 brokers or less. And the thinking there was, we concentrate our order flow, we become important to the broker, we have CSAs set up so that to the extent we need to pay secondary, tertiary firms for research content, we can trade with the bulge bracket guys, we can get the services, we can get the algorithms, we can get the technology, the coverage, etc., and we can use a check to pay the folks who perhaps don't have the full suite of execution capabilities. So that was kind of the best of both worlds. However, when the Lehman demise took place and the bankruptcy event took place, there was all of a sudden an issue on an equity trading desk with counterparty risk on trade date +3, and counterparty risk with reference to CSA balances sitting at a broker. So there was a new dimension and a new paradigm on the trading desk. How many brokers are we doing business with, and who are we concentrated with across all of our business? So our expectation was that there'd be an opportunity for the mid-tier firms, for the smaller boutique shops to come in and grab some of that market share and take advantage of the fact that they had good capital, they weren't involved in the credit crisis, they were stable organizations, and they would swoop in and sort of grab some of this market share at the expense of the bulge bracket firms. And that indeed did take place. However, the one jump ball that's sort of come back into play now is the investment banking calendar. And just in the last few days, we've begun to see items in the Wall Street Journal about IPOs. Julius Baer is coming with an asset management subsidiary IPO that could be the biggest one year to date in the U.S. We're seeing the Kraft Cadbury deal. What's Nestle going to do? We're seeing China buying Australian mining companies. We're seeing folks like Alan Schwartz, who was CEO of Bear Stearns, hiring investment bankers to build up his firm. So now, when we speak to buy-side traders, all of a sudden, there's talk about we need access to the calendar. We need access to the investment banks. We need access to research.
So what do you think, how's that going to impact? Is that going to be more difficult for these smaller firms to manage, or do you think the smaller firms will wind up getting pieces of these IPOs, or do you think that the flow will wind up reverting back to the bigger guys, or how do you see this shaking out?
I think we would expect that it once again is going to be the large global investment banks, the traditional bulge bracket folks who get these deals, who are the ones who are bringing these deals, and once again will be the beneficiaries of relationship with the buy side who needs access to these companies. So I think this brief window of opportunity for the mid-tier folks to capture market share perhaps has closed, and that the issue of concentration of order flow, not so much a concern. Counterparty risk, not so much a concern. The concern is there are deals coming, and I need to be talking to my bulge bracket firms, and I'm okay with concentrating order flow once again.
So concentration risk is out, concentration is back in, the calendar heats up, and it becomes harder for the smaller and medium tier guys to really, penetrate the shield of the bulge bracket. So maybe we wind up with one or two more bulge brackets filtering up into the upper tier, but by and large, it becomes an envelope that gets kind of everybody else is locked out.
That's right.
Well, with that, I want to thank Laurie Berke as a principal at TABB Group for sharing her thoughts, and I want to thank you for listening. I'm Larry TABB, founder and CEO of TABB Group, and that's it for our TABB Minute. Thank you very much.